Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Optimistic on reform, but warning bells on growth and the fisc, and yet another nudge to the central bank to ease interest rates. That, in essence, sums up the mid-year economic survey which has been tabled in Parliament. Hello and welcome to this special edition of Indionomics. I'm Lata Venkatesh. The report has emphasized that there are downside risks facing the economy, and achieving that 7.5% growth forecast looks difficult. This is the upper end, of course, of the government's projection. The RBI's has been 7.3. Another crucial warning is on the fisc. The survey cautions on fiscal slippages due to the farm loan waivers, that's on the state side, and on other spending sprees. But at the same time, it remains upbeat on meeting the fiscal deficit target. The survey also points out that inflation is likely to remain below the Reserve Bank's 4% forecast, and describes the scope for monetary easing as, in quotes, considerable. The survey argues that cyclical conditions suggest that the policy rate should actually be below the current rate. So in summary, the survey arrives at this conclusion: economy is yet to gather full momentum and still away from its potential. So this leaves us with three key questions. How serious is the warning on growth? Should we worry about fiscal slippages and the year-end fiscal deficit target? And third, should the Reserve Bank be more accommodative and cut policy rates? Joining me to discuss this are three top economists from the country: Sajid Chinoy, Chief Economist of JP Morgan; Soumyakanti Ghosh, Chief Economist, Economic Advisor at SBI; and Siddharth Sanyal, the economist from Barclays. Gentlemen, welcome. Before I start the discussion, let's listen to Dr. Bimal Jalan, former Reserve Bank Governor, who also was reacting to the initial comments from the economic survey mid-year review.
If I read all the forecasts, everybody is talking about it because of the impact, delayed impact of demonetization and so on, that the rate of growth may be lower than 7%. I mean, whether it is, what decimal point it is, I can't say. I mean, it can be 6.8, 6.7, but there is a view that the growth rate would not be what it was in last year, 15-16, that 16-17 would be lower. And that makes sense. We know that inflation rate would be low. I mean, whether it is 3.5%, 4%, and that the situation is much better than what was anticipated. And that part of the reason for that situation being much better is that consumer demand has gone down, amount of investment in the economy has gone down, and supposing all these changes, infrastructure investment increases, consumer demand increases, then the rate of inflation may also be higher.
Okay, that's Dr. Jalan. Actually stressing that the delayed effects of demonetization will be one reason why there will be question marks on growth, though he doesn't want to commit. Now, let me come straight away to that paragraph in the economic survey's first chapter, page 27 actually, where the survey is actually challenging whether we will be able to reach even 7% growth. What the survey is saying is that at the moment, the real growth in investment is 4.5%. In exports, it is 2% volume, and a decline in credit to GDP ratio of 2 percentage points. If you keep these parameters and look at any of the past 25 years, we have not been able to generate 7% growth. So that really is the question. If you have this kind of a capex growth and export volumes, partly because of a strong rupee, I would assume, can we really generate, and of course credit growth of just about 6%, then can we generate 7% growth? That is the question they are asking when they are challenging the current growth forecasts, which is about 7.3, 7.5. So let me come to you, Sajid, first on that. Is this a fair argument? Exports are not firing so much because of probably a strong rupee. The investment capex is nowhere where it used to be, and credit 6%. So how will you get to 7% is what they're asking.
No, it's a very fair argument, and I think I want to compliment the authors of the economic survey, because one theme you've seen over the last 3-4 years has been great honesty in the survey. And this is not the first year the survey has worried about growth. If you go back to the last 2 years as well, the survey makes the point that we're in an environment here where we're going to be struggling for growth to accelerate. I completely agree with the survey's conclusions on growth. We've had a similar view for the last 2 years. The fact is, India is in the midst or in the start of a deleveraging process. So in fact, credit growth should be even weaker going forward for the deleveraging to happen, number one. Number two, there was great optimism at the start of the year that exports would provide a significant tailwind to growth. We've seen that happened for 1 or 2 months. The last 3 months, in fact, things have been reverted. So, exports will be just modestly better than last year. Number three, I think the part we don't focus enough upon is the acceleration for growth in 17-18 was predicated in part of a very sharp recovery after demonetization. But as we've said in the past, even in the first quarter of this fiscal year, the recovery has been incomplete and patchy at best. And finally, I think, as the survey kind of points out, fiscal policy here is going to be neutral. The fiscal consolidation at the central level, in my view at least, may be offset partially by states. So you won't have any benefit from fiscal. So keeping these factors in mind, we're of the same view here. Growth is going to remain soft, may well dip below 7%, and and so that's something we have to all accept, learn to live with.
Oh, below 7%. What's the number you're working with, Sajid?
Our current forecast is about 7.2, Lata, but there's so much uncertainty in the current forecast because a lot of it hinges on some sort of recovery after demonetization, and a lot of it hinges on some pickup in exports sustaining. And in the last couple of months, both the export numbers and the fact that you've seen increasingly import substitution, the fact that non-oil, non-gold imports have been strong while domestic activity indicators have been soft, I think those create some downside to the forecast we work with.
Okay. Xiaomio, similar question to you. I don't know how much of the survey you could read. I couldn't read much, only patchily the first chapter. But would you agree with the questioning of the growth numbers itself? RBI's is 7.3. The survey is merely asking that do we have all the coordinates for a 7% growth?
No, I think as Sajid rightly pointed out, I think the economic survey has been very honest in terms of the growth assessment. And as of now, our growth forecast is also at 7.3%, but we believe that there are significant uncertainties. The primary uncertainties, if you look into the credit growth, I mean, just the credit growth, if you look into this year, the contraction in credit growth has been 1.5 lakh crores. So that is a big number, and the problem is it is happening across all sectors. Service sector, the housing sector, the only sector where it is growing this year is the personal loan segment, but I don't think that is basically the credit creation, because it is just giving you credit against your personal liability to the bank. So my sense is that, I mean, growth is going to remain weak. The export growth rate also, the rupee appreciation is also a significant factor. Export growth rate is going to be weak. There is a lot of imports from China. There is an element of domestic uncertainty in terms of the overall domestic industry is doing badly. So I think if we take all these factors, so there are too many moving parts in the room, and if we take all these factors into account, I agree with the assessment that there could be a downside, the downside estimate to the growth numbers which has been put out in the economic survey.
Okay, well, let me come to the fiscal side of the equation. The survey is saying that GST could give some outsized benefits. They go on to say textiles was never included. The imports were always taxed at, SAD and not at the special additional tax, used to be 4%, whereas internally VAT was 12.5%. And now, since there is more equivalence and recognition, there will be duty set-offs. They go on to say that the tax base has expanded. 6.6 lakh new people have registered. And you can now get the direct expenses of these guys who are in the tax net, and therefore direct taxes will improve. Yeah. While they say this, they are still questioning, because of farm loan waivers and because of overall growth issues, whether the fisc will be strained, and therefore it cannot even It will cut down on plan expenses. Where do you stand? Do you think we are going to surprise on the upside in the fisc, in revenue collection?
So there are many moving parts. You mentioned about the GST. GST is a big uncertainty, and we still don't know whether it will really be a positive surprise or a negative surprise, but it can potentially be a surprise, a sizable surprise, in which direction we are still not completely clear. What is somewhat more clear is on the direct tax side, where it looks like that after the demonetization there is greater compliance, vigilance is stronger, and possibly we see continued upside support from that particular side. So that remains supportive. The other area where the government had been getting some support earlier is the dividend, etc., from the PSU, where there was some kind of a quote-unquote disappointment yesterday. But I think in that kind of a scenario, another very important question is what we get to see on the disinvestment front. Okay. We have seen considerable disappointments over the last several years, but we managed to meet the fiscal targets. In this particular year, it might actually be a lot more crucial, because that's another sizable chunk of revenue or resource estimate for the government.
Okay. So, well, you know, what the survey says is that obviously even if the fiscal resources are not there, planned expenditure will be cut, and that will be a negativity on growth. So their conclusion is that the fiscal discipline will be maintained, but they are wondering if there can be some cut in planned expenses. Well, let me get one more question in, and then get into the big inflation and interest rate issue. The survey says that we have probably moved to a new normal in oil and in agricultural productivity. Would you agree, Sajid, that therefore we have to reassess inflation altogether?
I agree with those 2 points the survey makes completely. I think, the fundamentals of the oil market have changed structurally. We've gone from having a floor on oil prices to having a ceiling on oil prices, and that ceiling is progressively getting lower every year with the advent of shale technology. So I think that's exactly right. I think the other part the survey makes is also correct, in the sense that it points out we've had systematic inflation surprises to the downside. And as we've previously said, I think some of that is because some food disinflation we've seen in the last 3 or 4 years clearly has structural components to it. Otherwise, it's not possible to bring food inflation down, which was running in double digits for 6 years, down to 3 or 4% when you have back-to-back drought years. So I think on both those fronts, the survey is right that there is a supply-side element to the food inflation, and the worries about geopolitical risks associated with oil, I think, are less today. And perhaps in that respect, the survey is right that there is a paradigm shift happening with inflation. I would argue not just in India, around the world. You've seen downside surprises to inflation around the world for the last year or two, and that's led to this argument that maybe the Phillips curve around the world has become flatter or has a kink.
Yes, and the survey adds that on the minimum support prices front, the price support front, the current government has responded by changing the framework in which agricultural prices are determined. It has rationalized MSPs, minimum support price awards, liberalized agricultural marketing arrangements, and institutionalized the inflation targeting monetary policy committee framework. Now, Shaumya, given this, do you think that the survey is right in arguing that the Reserve Bank is missing the point, that there is a longer-term structural shift in inflation?
No, I agree with the point that there is a longer-term structural shift in inflation, because even if you look into the index, if you look into the CPI, the retail inflation which the RBI tracks in terms of inflation targeting, and the index over the last 3 years, you will find that, in fact, the food index has barely moved. And it was the case before demonetization, and after demonetization, there obviously has been a fall. So there is both a structural impact to it, and a transitory and a transient impact, and a structural impact to the food inflation. Now, having said that, in terms of whether the RBI, I mean, in terms of whether the RBI has missed it or not, yes, there has been inflation numbers in the past which has been significantly on the upside, as the economic survey rightly points out. But the good thing is that if you look into the latest inflation projections by the central bank, these are now more on in line with the expectations which the market has. It may still has an upward bias, but that is understood that in an inflation targeting regime, the central bank always wants to play a little bit cautious and tend to project the inflation number on the higher side. But as long as the difference between the two is not much, I think that should be taken with a caution by the market in terms of the, future accommodative monetary policy regime. So in my sense, I think that's a point of debate which we can get into.
Okay, that is the point of debate that we are going to get into. Is there a structural shift in inflation, and are there serious dangers to growth, and therefore should the Reserve Bank rethink its stance? That debate raised by the survey to my panel after this very short break. Welcome back to our special analysis of the Economic Survey Part 2, or midterm review, if you please. The three main questions that the survey has raised is, one, is it going to be difficult to achieve fiscal targets because of farm loan waivers and because of the growth scenario? Two, whether economic growth itself is going to be a little lower than several floating forecasts, which are between 7.3 and 7.5. And third, whether there is a structural shift in inflation and therefore the Reserve Bank has more space. Well, let me come to the issue of farm loan waivers. Sajid, the argument of the survey is that because there is farm loan waiver, the Reserve Bank should not assume higher inflation. On the contrary, it will be a contraction of demand. How is that explained?
So I think, just stepping back, Lata, the survey has a great analytical depth and rigor and a must-read for everybody. It makes a very interesting point here that just when we look at the central government fiscal deficit, we net out asset sales and bank recapitalization to compute the actual fiscal impulse. What the survey says is, when looking at state finances, to the extent that states have a hard budget constraint of 3%, and to the extent that some of these states have come up against that, the more farm loan waivers there are, the more states will have to cut either expenditure or raise taxes to be able to finance the farm loan waiver. And what the survey says is that we then, to understand the impact on aggregate demand, one has to look at the elasticity of higher consumption by farmers in the event of a farm loan waiver and trade that off against the higher elasticity of lost spending or taxes that states have to undertake. So it's a very interesting and important argument, I think, that the conventional wisdom may not be correct. But I would simply offset that by saying, over the last 3 or 4 years, I'm a little bit wary about arguing that states are going to be prudent. Given the history of the last 3 or 4 years, you've seen state deficits widen very much. And so even while the survey is right that the 5 or 6 states with debt waivers may actually have to cut other expenditure and reduce their demand, it's also equally true that there are many other states who are below the 3% limit who may actually increase their fiscal deficit. So what the consolidated fiscal deficit is at the state level, X loan waivers, could go either way. One other point I'll make is, I think generally, apart from this issue, fiscal risks have clearly risen for states in the next 2 years. They've got their pay commissions.
Yes.
They're struggling on the revenue side, both with lower stamp duties and alcohol revenue realizations. So I think the state picture is far more complicated, and I think there are a lot of risks there. But the survey makes an interesting point on how we should think about the impacts of debt waiver on aggregate demand.
I'm inclined to agree with the state simply because I know several of my own relatives. There are times when the states don't pay teachers' salaries because they have to meet deficit. It is a fairly hard target. The way fiscal deficit for states is implemented, they had to beg their way out when Uday reforms were implemented and the DISCOM loans became a part of state government loans. So there may be some truth in what the survey is saying. Soumya, the other question I wanted to ask you is that the survey takes for granted that India is in a new normal with respect to macros in general, current account deficit under control, simply because oil is going to not be an issue, and agricultural productivity and the way in which minimum support prices and marketing is being organized, or the GST and the tax trail that governments have. All this have set a new normal for macros. Do you agree that those macros are actually positive?
No, I tend to agree with the fact that the India is actually in the new, the macro narrative is actually far better than what we was witnessing in the last 3 years. And it's a good thing that we have built a large part of it, specifically the fiscal consolidation part. Against market pressures, the way the fiscal deficit has been consolidated, the external sector numbers look, quite decent. The inflation has structurally corrected from 11% to around 4%, that too on a consistent basis. And also the fact that, there has been, if you look into the other numbers, apart from the real sector activity, I think most of the other numbers are looking much better than what it was last 3 years. But that doesn't mean that we should be complacent enough. I think there are still some signals, for example, like the farm loan waiver. Then there is also the fact that the growth is not picking up. There is an issue, a little bit stress on the fiscal side, given that the numbers from the RBI dividend payment has nearly halved. Yes. So I think we should not sit complacent, and there are some dangers, some lurking dangers, at least in terms of the fiscal path and also in terms of an overvalued exchange rate, which we should be a little worried with in the coming days. Okay.
Well, actually, in the first part of in the first chapter, there isn't much discussion of overvaluation of the currency. Yes, that definitely remains a challenge to exports as well as to domestic industry. Final question to you, Siddharth. Are you convinced of the argument that there is more space for the Reserve Bank? And should the Reserve Bank were to oblige with another cut, does that really solve the growth problem?
Well, I would rather tend to be a little more conservative here. I think going by our traditional framework, where inflation used to be slightly higher than what we are seeing now, the current 6% range of repo rate is kind of the lower end of the spectrum of the usual habitat for repo rate. So from that point onwards, whether the Reserve Bank cuts more, now we are not discussing about one more cut or something like that now. Structurally, whether there is room for considerable space, as the Eco Survey has kindly pointed out. So if that is the argument, I would rather expect the Reserve Bank to be going very, very slow at this point of time. They would like to be 200% sure about that particular scenario rather than jumping guns and offering significant cuts at this stage.
Very quickly, all three of you, please try and give me monosyllabic answers. Do you think that for this year, perhaps the macros are not in alignment for a 7% plus growth, but the economy can rebound very sharply in 2019 because the macros are in place? 2018, 7% plus?
We are quite positive about the economy for over a 3 to 5 year kind of a horizon. 7
this
to 8%
year, 7%?
Plus. 7% plus.
Okay. Sajid, this year, 7%?
Well, let me just say very high marks on macro stability, which is the #1 priority. I think this year and next year, possibly just about 7 to have a more sustainable recovery, much higher than 7. We'll have to wait, I think, at least 2 or 3 years.
Okay. Soumya?
No, I think this year could be a little bit difficult to be a decent number, but I am hopeful that the recovery will be faster enough once we settle down into the new normal post-GST and demonetization.
All right, then I don't see my panel disagreeing seriously with the survey's forecast, except perhaps Siddharth, who thinks that growth is not going to be impacted. Otherwise, there are dangers to growth, but because the macros are so much in place, perhaps we are going to fire away much better in the subsequent years. Maybe this year is going to be tough. That's the conclusion of the survey, and that's the conclusion of a majority of our panel as well. We wrap up our special show on the economic survey. Thank you very much for watching.
Hello and welcome to Taking Stock, the show where we take stock of the week gone by and prepare you for the next trading week. I'm Surabhi Upadhyay, and with me is Anuj Singhal. Hi Anuj, and quite a week it's been for the Bulls and the Bears actually.
Oh yes, quite a week, and last week we were talking about greed, and this week we're talking about fear. That's the market, right? I mean, greed and fear, and just 2 weeks back it was just about which stock do you want to buy. This week was all about which stock do you want to sell.
Okay, we'll talk more about the markets and all that's happened this week in just a bit. Let's first start up with the top market headlines of the week. Bears dominate sentiment on the street for the week. The Nifty cracks 3.5%, ends at 97.10 on Friday. The Sensex tanks to end just above the 31,200 mark. Mid-caps take a much bigger beating. The mid-cap index down over 5% for the week. It was an earnings-heavy week. Banking big boy State Bank of India's asset quality disappointed, while Tata Motors cracked after Jaguar Land Rover margins came in at multi-quarter lows. Aurobindo Pharma also disappointed in the first quarter, with net profit falling 11%. Tata Steel saw a better-than-expected quarter. SEBI initiates action against 331 firms suspected of being shell companies, restricts trading in almost all of those companies to once a month. However, J. Kumar Infra, Prakash Industries and some others managed to get relief. The SAT lifts the SEBI trading ban on these companies. The mid-year review of the economic survey shows a fear that growth may be lower than forecast, expects inflation to be sub 4% by March. Okay, those are the headlines. And of course, as we told you, it was quite a bit of a sell-off, particularly in the mid-cap market. Anuj, now 5.5% lower on this side of the market. Many stocks are down between 20 to 25%. I think the one thing everyone's wondering is the worst over.
Yeah, I mean, I don't know about that, Surbhi, but, 2 or 3 things played out this week. It was almost like Murphy's Law. Global, local, all cues were negative. You had the skirmish between the US and the North Korean side. The earnings season, I think, towards the end ended on a really bad note. The numbers from TVS Motor, I think State Bank of India, I think that's something that the market didn't like. And the market has now given up almost 2/3 of last month's rally. So that's something which is interesting. The big question is, has the risk reward turned favorable for the market now? I think 2 or 3 things for me. One, that the mid-cap deleveraging, which started this week on Tuesday, I think that's played out now. From now on, you can't blame the market's fall on mid-cap deleveraging. That is over now. If global markets turn from here, in that case, of course, these things will not matter. I mean, if global markets continue to make new lows, then you'll fall along with global markets. That's a fact. If, for example, on Monday, the Dow is again down 200, 300 points, you will react to that, next day. But if global markets sort themselves out, I think the mid-cap side in particular could have reached a stage where you see some bit of bounce. I think on Friday, you saw a bit of a bounce in names like Tata Global, CG Power. I think clearly the risk reward might be turning favorable, but the caveat is that global cues, that's something to watch out for.
Oh, well, and that's become a bit of a talking point right now. Joining in to discuss all of these factors, the week gone by and the road ahead, are Basant Maheshwari of Basant Maheshwari Wealth Advisors, and we also have Ashwini Gujral joining in on the technicals to read the technical picture for this market. Basant, let me start with you first. 3.5% gone as far as the large cap indices are concerned. 5.5% gone from the mid caps. What's the sense? Is it just a bit of the so-called cliched healthy shakeout that the market is seeing? Or is there something more to it, you think?
Hi. I mean, in the over 20 years that I've been in the market, we've always termed the correction as healthy. But let me tell you, it's never healthy. It's painful. And irrespective of how experienced you are or how long you have been in the market, how can you be okay with money going off on the screen? But you have to take it. See, bull markets are like roller coasters, and occasionally the seat belt comes off, and that's when you have to just hold on to the handle and say, the companies that we own are good, they're going to deliver good earnings, and we're going to stay with them. So I think this is just one of them, but whether the correction is healthy or unhealthy or fat or thin depends entirely on the kind of companies you own. If you're sure of the company is delivering earnings, then I think it's fine. It's time to go and buy more. But let me tell you, Surbhi, nobody buys when the markets are down. So because when they fall 5%, you want it 5% lower. So ultimately, you have to buy it when they go up. Of course, in theory, you should be buying when they are down. But the basic problem in the market setup like this, it's not a problem. It's more of a psychological impact is, you don't become rich by buying a stock 5% lower. You become rich when a stock goes up 5 times, 7 times, 10 times. So you just buy it 5, 7, 8% down, or you buy it at that price, it doesn't matter. What matters is what you're buying. So that's the point to be focused on.
Interesting point. Basant, hi, I'll come back to you. But Ashwini, I wanted to address the same point with you as well. We all say that this is a buy on dips market and wait for dips to buy. But when the dip comes, then people develop cold feet. But your thoughts on whether something has changed for the market, or is the larger texture still buy on dips?
Well, what's changed is that you are going through a correction, and it is a synchronized global correction. I don't remember in the last 6-7 months when has been a global correction that's happened. Now, if next week global correction is over, everybody forgets what happened, and we all go up. But if globally markets remain weak, there is no way you can go back up. You can do what you like. Plus, we are not setting ourselves in any kind of glory with the kind of results that are there. We were anyway tagging along with the global market. So it's basically that simple. It's liquidity. It's got nothing to do with what's happening in the fundamentals, etc. So till the liquidity is weak, till the global markets fall, till geopolitics is on the wrong side, I think we will go down. And there shouldn't be a problem if you have a 3 to 4 week of sharp correction. This is that sort of period, August, September, when a cyclical downside happens every year. So my sense is it should continue for a bit. If we are let off easy, I won't bet on the upside sustaining, because the right kind of period for this to restart is probably closer to middle of September.
Okay. Basant, the other issue for this market has been that it was heavy. I mean, we saw that last month rally, for example, it was up from 94.50 to 10,100 non-stop. And even before that, the sharpest correction that we have had was only 200 points. Whereas in 2003 to 7, we had at least 3 corrections which were 20 to 30%. Do you think there's a risk of this market going through its first genuine correction of at least 10%?
10% would be too much for the index. I mean, I don't know whether it's going to go down 10% or not, but 10% would be too much, because if the index falls 10%, individual portfolios would fall 25-30% unless you are invested in those isolated names here and there. So, but even if it falls 5, 7, 8%, I think it's enough. I mean, 4%, we're talking about the market falling every day. But on an overall scale, Anuj, if you look at the entire gamut of the companies that are coming out with results, you can write no thesis on a bull market out of forming out of the entire 30 or stocks of the Sensex or the 50 stocks of the Nifty. A 10% NPA with a 10 times leverage means the book value is gone. You just look at the results that are pouring in. And 2 years back, the self-proponent value investors were cherishing on the fact that why don't you buy a 2 times book or 1.5 times book or a half times book stock. So today the entire book is gone. So today the 4 times book HDFC Bank, of course there's no recommendation if you don't own it, looks far better than the half time or the 1 time or the 1.5 time book PSU banks that people were pushing around for 2 years back. So I think let's leave the market aside. Let's leave prices aside. You just have to focus whether the companies you own are going to grow at a steady rate or not. If they are going to grow at a steady rate, it doesn't matter whether the Nifty falls 5% or 10%. But if there is even a small iota of doubt about these companies growing at a steady rate, I think we should jump ship and go to the companies where growth is sustainable, predictable, and surer.
So, Basant, one of those islands that you've liked in the past has been, I think, housing finance companies within the NBFC universe. What does the first quarter evidence tell you? Is there more steam left? Because NBFCs have been all over the place. I mean, there have been people with the sort of quasi-MFI sort of lending where there's a lot of pain. Then there are the Bajaj finances of the world continue to march on. What would you buy, if anything at all, fresh in this current fall?
The problem about buying fresh is obviously the housing finance companies which we own have delivered extraordinary results, growing at 35% to 45% as we envisage them. We don't own everything, obviously, because we focus and we concentrate across. But on an overall scale, I think when you want to buy something new, the strange thing about the market is the stocks that you own are already down 5, 7, 8%. So then you say, should I buy the new stock or should I just build on the existing position? So, because the existing stock, you've known it for years, you understand how the management functions, you understand how they talk about. So every time the market falls, we end up buying more of what we own, even though we assume that in theory that, when the market falls, we're going to buy something new. So housing finance, NBFCs, and the retail lending companies, they'll do fine. They're growing as a sector at 20-25%, and the good companies can easily grow at 25-30%. But the market beyond this, maybe consumer names, a couple of them are doing fine. But beyond this, there is no backup of earnings. I mean, a consumer company comes out and says, we did double-digit growth. I mean, double-digit means 10 or 11. You're just a little embarrassed of saying we're doing 11%, so you say we did double-digit. So double-digit growth is not good enough. Companies which are grow at 25-30%, and today we saw the first signs of the high-growth companies. They were able to sustain themselves even when the Nifty was down 100 points. So still a long distance to go. Let's see what happens.
Still long distance to go. What kind of stocks to trade then? Ashwini, what would be the top picks for next week, long or short?
See, again, you can't, broad brush things. There are, stocks on both sides. Particularly, I like the way Motherson is shaping up. It basically found support yesterday and today at about 300. So that becomes a decent stop, and possibly if we have a couple of good days, even if the market is sideways, I expect this to go to 360, 365. Also, Bajaj Finance, it moved up fairly strongly from lower levels. So here, even if it declines, you can buy and probably keep targets of 1750. I think metals have started a correction, and you will probably find Hindalco going back towards 185.
Okay, gentlemen, let's do one thing. Please stay on. We'll take a break. We have a lot more questions for you. We'll come back and address those questions. As we take the break, let's hear out some market opinion that we heard through the week.
My sense is that this is the bombastic talk from North Korea that we've seen in the past. It will not follow with any action, but over the next couple of weeks, maybe the saber rattling will continue. So the markets will probably remain range bound, but I don't see a massive sell-off. I see more of the kind of profit taking we're seeing now, maybe for another couple of days, but I really don't see this as a beginning of anything fundamentally changing the market. I just see this as introducing much needed a little bit more balance in the market, and therefore probably corrections like this are healthy in driving a long-term fundamental growth in markets around the world.
I am still very bullish. All I was saying was that don't use that as an argument forever, saying that because we have new investors coming in and because they are waiting on the sideline, nothing else matters. Right now, I am not thinking that these geopolitical issues are suddenly very serious. This was said in a bravado, and that is how this world works, but I don't think that will be taken so seriously.